Hello everybody, welcome to the TraderMerlin Show, getting ever so close to that weekend. It's your Thursday edition, another crazy day in the markets. I feel like I'm being monotonous as I say another crazy day in the markets. Crude oil, again, up 20-something%, but I'm going to start off by going through some of the top 7. I've actually gotten a lot of great feedback from many of you. I've kind of in this turmoil, whether I cut the opening segment, which has the top 7 markets, or truncate it, or just keep it the way it is. I'll probably modify it and maybe cut it down a little bit from 7, maybe to go 4 or 3, or the important ones. Anyway, big shout out to everybody out there. Thank you guys so much for the nice comments out there. You guys are awesome. Marco says the most exciting part of the day is this show in the chat. Awesome. Love that. That's great. Glad to hear I could be a part of your trading day, at least the end of the trading session. So hello to everybody out there. I see a ton of new faces, new names. If you are new to the show, do me a big favor, click the subscribe button, hit the thumbs up, and also go to iTunes and download the podcast. Even if you don't listen to it, it just helps the rankings of the podcast if I just get people listening to it. All right, here's our plan for today. We're going to do, obviously, a little bit of a market overview. Then we're going to bring on a longtime floor trader out of Chicago, just an amazing guy. Every year at the conference, I have an opportunity to sit with him and some of the other Chicago traders, and I absolutely love hanging out with them. Just a real straight shooter, very mellow guy, but he's got some interesting perspectives on the market. We were talking earlier today, and he's like, look, I really see some parallels to things we've seen in the past, and that does not bode well for our markets, meaning it bodes kind of ask the question, are we ready for another major correction? There's some things setting up. We all know the history teaches us things from the past. We might be able to carry that forward and create some opportunities. So let me start with our market updates out there today. I will start from the bottom and work my way up to the top. Not a lot to speak of. Treasury yields were nothing to speak of, so I'm going to skip right over that. Let's go to, how about I go to the market, and I'm going to bring up first. S&P 500 was basically unchanged. The only thing that's noteworthy and worth me sharing that chart, and I'll bring up, we'll do it in Clik. I finally found my login for that one. Here is your daily of it. What's noteworthy was the move that happened. So you guys see this little tiny candle right here. At one point, we had a pretty good update going, right? 2% plus. Gave it all back and actually ended negative just barely. That is a nice reversal sign. It's actually a very bearish sign, basically saying that the sellers sellers won and the buyers gave up at the end of the session, and it's also not tanking, but selling off here in the after hours. So that's even though it's not a big candle, there's a language, there's a communication being done with the way that this candle closed, and it is bearish. It's the same picture for the NASDAQ, and I'll show you the NASDAQ right now. The noteworthy thing about the NASDAQ is Intel came out with earnings after hours today. They did not do well, my friends. I'll show you that chart here in just a second. Moving on up, forget the Dow. That was positive, but just barely. Gold was rather noteworthy. Gold continuing to move back up above that 1700 mark. Today we had gold closing at 1751. That's a gain of 0.73. The only noteworthy thing from the index perspectives was the Russell 2000. You saw the Russell did not show a red candle. It's a green candle. I know it's kind of hard to see here. I'll try to zoom in. A little bit of a green candle, although it did give back a lot of the gains. It was up 1%. Crypto news. I got to do a crypto show at some point, but I'm not going to do it today. Big move early this morning, 5, 6, 7 o'clock in the morning. Bitcoin had a pretty nice rally. Ended up, right now it's up about 5.88% on the session. That's a pretty nice move of about $300 on the day in the last 24 hours. But that's not the story. The story, as usual, goes back to crude oil. We'll bring up the CL charts. Another 23% move to the upside for crude oil. What's interesting for me, guys, when I look at this chart, it doesn't look like we're having 23% moves. It looks like just normal price moves out there to the upside, but those are massive gains. And shame on you, I have to do this really correctly because who knows, maybe there'll be a sponsor someday. Shame on you, all trading firms, for halting and not allowing anybody to trade crude oil. These are some of the most volatile times, and to me, this is culling the herd, if you will. If you are dumb enough to put everything into crude oil and not use stop losses and get blown out, that's on you. But you can allow us to go out there, take some risk, trade crude oil, have stop losses in place. Granted, we'll probably take some losses along the way, but these are just amazing moves out there, some incredible opportunity out there. So there we go. That was your market update, your top 7, done very, very, very quickly today. Why? Because I've got a couple things I want to do. I've been wanting to do this series called Stories from the Floor. Over years of meeting some of these Chicago floor traders, I just love hearing their stories and things that they have done. And I have met many of them. You know, you've got your Craig Weil, your Marty Dim, your Bob Dunn, your Bill Henner. And of course, today, our guest on the show is none other than Mr. Bill Henner. So, Bill, how are you doing today?
I'm doing great, Merlin. It's wonderful to be back with you.
It's a rarity. And normally we get to do things when I was on Power Trading Radio. Now it's a little bit different. Unfortunately, it's not Friday, or I would say let's have a cocktail. Friday is the cocktail show. We're kind of crafting that one out there. But I want to do something very, very quick and simple here to start the show. I call it the Trader Profile. And really what I want to do is give everybody an understanding of three simple things. How long you've been trading, what you are trading, or what's your expertise, and what is your trading style. So how about you walk our viewers through those three things?
Okay, well, again, I'm giving my age away right now, but I actually started trading way back in 1979. So I am actually now have over 40 years of experience in the markets. And that's when I started trading, but I actually, even before that, I worked in the industry as a runner, going back all the way to my high school days. So I've kind of grown up with this stuff, and as you probably are aware, and a lot of people know, my father was also in the business, and in fact, my grandfather was briefly in it. So I've got kind of a lot of markets in my DNA, I guess. So that's the duration part. In terms of, now you wanted to know what markets I trade? Is that the second question?
Yeah. So
okay.
You got the experience, and obviously it's great having this pedigree. I love seeing that. And then, what is your kind of, would you say, markets that you trade?
Well, you know, I, again, like most people, I certainly have a bit of an affinity for the stock index futures markets. I'm a dyed-in-the-wool futures trader. You know, again, doing it for 40 years tends to, develop a certain degree of comfort. But most of my on-the-floor trading career, my specialty was actually Forex futures. I traded Swiss francs, German marks, British pounds. Those were the three primary currencies that I kind of worked my way through. And I still, I think, definitely have a bit of an affinity for Forex futures trading, which of course is just really a proxy for the primary Forex market itself. And the thing I really like about Forex markets is the kind of the directionality of them, I guess it would be. That when they do pick a direction, they tend to be, certainly in my view, the best trending markets of all. Again, to me, the index futures, the S&P, the NASDAQ, the Dow, even the Russell, they're really, I think, better suited for short-term trading, just simply because of the fact that they don't go in one direction. They do a lot of major rotations along the way, which in my view makes trying to hold a position for an extended move really kind of difficult, because it's just brutal to watch how much the market of your open position profits disappear on the way to bigger ones. Right. I think currencies tend to be a little less rotational along the way.
Does that said, is that kind of your style, is the shorter term trading style?
Yeah, again, that's a question I always get, certainly from my students. They always say, Bill, what's your style of trading? I look at myself as generally a day trader by nature. Again, spending many, many years on the trading floor kind of developed that. But in my view, the beautiful thing about the futures markets, and certainly Forex as well, is the fact that because they trade actively around the clock, I don't feel any necessity to close positions at the end of the day if I believe there's still more to be had in terms of the move that's ongoing. So, to me, the nice thing about futures is that I, except over the weekend, I feel like the market is essentially nonstop, and I can protect myself safely through the overnight sessions. So, bottom line, I tend to be pretty short-term in nature, but I'm certainly not averse to holding a position for several days, which would put me more into technically a swing trader category.
Right. All right, so you got the three questions answered, everybody. He's a long-time floor trader from Chicago. Currency futures was kind of where he cut his teeth, trades futures right now, and he is a shorter-term trader by nature, but hey, you know what? Just like me, if I'm in something and the opportunity looks like it's going to continue to run, I'll stay in it for as long as need be, or as long as I think that there's still some quote-unquote meat on the bone. That, my friends, is your trader profile for Mr. Bill Henner. All right, let's go back to question time. You and I talked earlier about markets and patterns that emerge in markets. I know that was probably one of the staples of how you analyze things. I titled today's show "The Next Crash" and walk our viewers through kind of what you're seeing. I can draw whatever you want on charts for the audience, but what is it out there right now that kind of has you spooked or thinking that we are already poised for another crash?
Okay. Well, again, in my view, what we're seeing right now, obviously the COVID-19 situation was really a catalyst. Certainly it was a real good excuse for the markets to go down. But I think, certainly in my view, with the normal perspective over a course of history, this was a market that was long overdue for a correction. Mm-hmm. I think most of us have kind of been scratching our heads for the last 6 months, wondering why the market was still holding up so well, because frankly I guess traders, investors would say the market was really priced for perfection. And, again, the trend was up. So a lot of times it does take a bit of a cataclysmic event to turn around a big trend like that. But I think most people would agree that this was a market that was looking for an excuse to correct. Mm-hmm. Okay. And certainly we got that in spades back at the end of February once it became very clear that this wasn't something that was going to magically disappear, that was going to be gone by April or whatever the heck the narrative was at the time.
Right.
So, and again, I tend to always value historical examples. Again, I think it was Mark Twain said, history doesn't repeat itself, but it sure rhymes. And I think, again, as traders, especially, what we generally do and the way we make our living is by looking for essentially repetitive behavioral patterns in the market. Some very short term, some longer term in nature. But again, starting with the idea that the market was a bit overdue for a correction. I think the normal thing to compare this to, again, the most two obvious relatively recent examples would be the last two big setbacks we've had in the market, the financial crisis going from 08 to 09, and certainly the dot-com bubble that ended in 2000. Mm-hmm. And again, each of those corrections, as they were, resulted in a market drop based on the S&P of about 50%, a bit more actually, if you want to get specific about it. But, and so basically that's what we normally get when a bull market comes to its normal cyclical end. And I think most of us would agree now that what we're seeing in terms of fundamentals, in terms of impact on the economy, is an event that logically dwarfs both the 08 and the 2000 situations.
Right.
So I think, again, it's logical, if you start with that assumption, to assume that what the market has done before is likely to be what it's going to do again. And that would imply a move of at least 50% off whatever the high was. And, again, the high was about 3,400. So wouldn't surprise me to see the market at least get down to that, about half that, around 1,700. Okay.
Let me, real quick before you get there, I want to do a little bit of comparison and contrast for the viewers so you guys can see we've been bouncing back and forth between a couple different charts. The first one that we were looking at there, actually, this one here is the S&P 500. And as Bill's pointing out, you do have a pretty significant sell-off that obviously we topped out at, what was that? Give me the exact price there. Your high was 33.86 on the continuous. We bottomed out, a month later down at a low around 21.74. Obviously, that's a huge decline. Now, what's interesting about this, and this is what I kind of want to steer the conversation to, is behavioral patterns and fear and greed and herd mentality. You have this aggressive sell-off. And when we got down here, as we were falling, guys, I'll do a little bit of what I like to call the hard right edge and show you guys how this works here. I'm just going as the market falls. When we were right here, I had with 2,900, I had tons of people saying, I'm going to buy. This is the buy point. I don't know. Then all of a sudden it's at 28. Oh, this is the buy point. I'm going to buy. I don't know. And then all of a sudden it's at 2,400. This is the buy point. I'm going to buy. And it keeps going. And all of a sudden we find ourselves at 2,200. This is the buy point. I'm going to buy. If you're in that type of mindset where you are buying and buying and buying every time this thing drops, you are ultimately going to hit a point where you're broke. Because you're trying to pick the bottoms because you want to join a rally that has been intact for the past decade. Now, that said, I have some comparison and contrast pieces here just to show you kind of where we are at now. There is an interesting phenomenon that happens when you have an aggressive sell-off and then a market rally. And I'll put those side by side here. What I'm going to show them now, Bill, is this is the crash from, this is the '08 crash. So it started late '07. We dropped 24%, but I want you guys to notice the shape. An aggressive sell-off followed by a pretty large bounce. I mean, it was a 17% move in, this is a weekly, so, a couple of months, it jumped 17%. Now I'm going to stack that on top of the market that we have now. Down at the bottom, that's the market that we're currently in. This is a daily at the bottom, a weekly on the top, so the scales are a little bit different. But notice the same picture. Aggressive sell-off of 35, call it 36%. A nice rally of 32%. And during this rally of 32%, the institutions have now flip-flopped. They're now saying, this is the buy point. You should be looking to buy right now. If this is the bottom is in. Correct me if I'm wrong, Bill, but weren't they saying that same thing back in April and May of 2008?
Exactly. In fact, okay, I remember in May of '08, right after the market had that very sizable run-up, the one you've got displayed right there, I remember on CNBC, you couldn't find a bear on the network. I mean, they were telling everybody, all the reasons why the storm has passed, how it's safe to get back in. And I'll never forget seeing an article, it was on CNBC homepage, saying that during the course of that last couple weeks of April, first couple weeks of May in '08, record amounts of retail money came into the stock market and mutual funds. So it was really a setup for a slaughter.
I'll continue on with that full that picture just to show you guys as I click forward what happened. When we look at this, certainly if you back in 2008, if you're buying at 24% off, you're thinking that's a hell of a deal. I'm looking to buy it. And yes, there's opportunity, but I just wanted to go forward to show you that you got to remember that these things will take time to filter out. I mean, it fell from the low point there. It fell another, I'm just going to give the number here, another 54% from that low point, right? All in all, we were down about 50, I think we were down 50%. It was actually over 50%. I think it was 58 if I'm not mistaken. We'll throw up a number here just so you guys can see the actual number.
Yeah, well, it basically went from about, I think it was 14 something down to under 700. I mean, I do recall the low of the front month contract on the S&P was 665.75.
Right. So, kind of the direction that I titled this one, the next market crash, is basically that, because this picture that we're looking at, I think if we put the current market situation, I think most of our viewers agree, and it's probably why you listen to the show, because we have the same basic mindset. Some of you might not, and that's totally fine. Please, you don't not have to agree with what we say. But this is, to me, very similar picture where right now you've got a nice market rally. Things are looking great. What's really crazy for me, Bill, is the markets are shrugging off bad news. And it's just like, It's already priced in. It's already priced in. I'll give you an example. When we look at the initial claims numbers that came out today, if you go back to last month, not including today's numbers, but the last 4 weeks, it was 22 million people filed initial unemployment claims. That is 13.6% of all working Americans are out of work. Good luck getting loans. Good luck spending. It's a mess. Today we came out with another 4 million added to that, which bumps it up to about 15.6% of the American workforce is out of jobs, and that's
already
26 million people. And we're shrugging it off like nothing.
Right.
To me, this is still a lag effect, right? So you've seen this type of thing before. What should we be looking for as a signal or catalyst that next leg is coming, or is it just wait for pure price levels to break?
I think it's really the latter. Although I'm not averse to start scaling in at or above current prices. I think, again, a lot of times they really set the hook very well on these types of things.
Mm-hmm.
We haven't seen quite enough, in my view, just unbridled optimism about prospects going forward. Maybe we'll get a few of these companies coming out with earnings that somehow look better than expected, with I don't know how they come out with positive forward guidance at this point, but but it's amazing what they do. And again, if you think about what has gone into creating this rally, I mean, we've got unprecedented amount of Federal Reserve activity. We've never seen anything quite as aggressive as this. The government's Congress has literally thrown over $2 trillion at this problem. It shouldn't surprise anyone that they were able to push the market up a little bit. They can make water run uphill for a month or two if they put everything they've got into play. But that ultimately, we have an old saying, and I'm sure you've heard it many times, nobody, even the government, is bigger than the market ultimately.
Yeah, and that was my next question to you. When we were looking at these pictures side by side, we saw something happen in 2008 to 9, which was an incredibly quick reduction in the Fed funds rate, went down to 0. Then we saw quantitative easing, 1, 2, 3, Operation Twist, and other things to help stimulate the economy. Now, there's still some remnants of that in our system now as we approach 2020, but all of a sudden we immediately slashed. That was an unprecedented cut, series of cuts to bring us down to 0 again on the Fed funds rate. We're teetering with that inverted yield curve thing, so there's issues there. You also have trillions of dollars being put in. We're not going to call it QE4, but there is, obviously a ton of money coming in. Is this picture somehow different than, because it seems like they're throwing everything they can possibly do. They're sending checks out for $1,200 to the working American. Again, is this different, or is this?
I don't want to sound at the risk of sounding a bit cynical here. I think they've already used all their ammo, and if it starts going now, they've got nothing left. The old talk about pushing on a string. The Fed is literally out of bullets. Yeah, they can keep doing QE and things of that nature, and I think they're also going to. I think we're getting into an issue where they're going to have a real problem with the value of the U.S. dollar right now. Some of the best and smartest fundamental guys I know are talking about there being a real problem with too much basically artificially induced demand for U.S. dollars. And if the dollar keeps appreciating, that's going to have a lot of real problems for people, for entities all over the world. So who knows? We may even get back into an era of something I haven't seen in several decades, where you've actually got central banks intervening to try to manipulate the price of the dollar and other currencies, which certainly could become a very interesting trading environment.
Well, I think we've already kind of seen the manipulation influence by central banks on not just the U.S. dollar, but central banks around the world trying to influence their currency, whether it's the yuan or the euro or the pound. There's certainly things being done to manipulate it. And, the comment that's come up is, it's always a crude saying, but the dollar is still the prettiest horse at the glue factory. So that will continue to increase its move up.
Yeah, or as we sometimes say, the cleanest shirt in the bag of dirty laundry.
That's probably a little more politically correct and not as gross, but
Yeah, in case we got some animal lovers out there.
Yeah. All right. So you're of the mindset that we look at this chart that there is some big downside coming here. What is your target? Do you have a target?
Again, if we go back and take a look, I started with the thesis of approximately a half-off sale on stocks from the top, which would take us to about 1,700. Yeah. I think it's kind of interesting, though, if you look back at weekly charts on the S&P. Now, the only problem is you've got that adjusted continuous contract, which doesn't show the, if you do the add ES equals 107XN instead, it gives us a more accurate representation. But the point I wanted to make was, if you look back, the highs that were created in 2000 and again in 2007 were basically both around 1550 on the S&P. So if you think about it, looking at a weekly chart, what you're really looking at is it was a huge upside breakout of a double top pattern, with one top being in whatever it was, 07, one top being in 2000. So basically what I'm looking at is a pullback, a retest of that breakout on the weekly charts. Or even a monthly chart might even show it even better.
I've got the weekly up here, just kind of redrawing things out there for you. So there's that double top that Bill's talking about, guys. What I'm gonna do is just put a line right across, which it's very close to 1,600. would be kind of the peaks.
I think it was like 1585 in '07, and it was like 1550 in 2000. But same idea. So if you look at that, you can see that from that point, it was a real nice breakout that set the stage for this move that's taken us all the way to the recent highs. And, again, if you think back, if you go back prior to 2013, which really isn't necessarily ancient history, those were high prices. Okay, those were the all-time highs. So really what we're seeing is a market that's just kind of going back to revisit where the most recent big part of the bull market started from.
Yeah. And looking at this, the 1700 is certainly a lofty goal down there. I'm actually going to move this line up, guys, just so it lines up a little bit better. I'll put it right at 1700. My target as we speak is 1800, and that's just because of the taps that it's had before. You can see back in 2016, hit it a couple times, but markets are about levels, and once one level breaks, it goes to the next one. And someone asked me once about how I break that down, and I always come from this perspective of think of like a multi-story building, right? You got this multi-story building, and the top floor, 10th floor, 9th floor, 8th, 5th, you can jump up and down any you want on that floor that you're on. Let's say you have a jackhammer and you chip away, eventually that's going to end up breaking through. Where are you going to fall to? The next one. So there are logical stopping points along the way. Right now we're toying with the 2,800 level on the S&P. I'm actually short right now. I've meant to mention that. I have 4 S&P contracts short right now, which I'll be carrying into tonight and see what happens there. But 1,700, that seems like a long ways away, guy. That's 1,000 points, over 1,000 points away from where we currently are at. And it's not saying you want to capture all of it. But certainly hopefully we can get ourselves in there and capture some of those moves as this market starts to go down. There were a couple questions that came in here. Let me see real quick. Kyoku Shinkai, that's a tough name for me to pronounce, brother. It's a long one. Kyoku Shinkai 10 says, if that happens, would supply and demand the way we do it at OTA still work? So let's say it drops 1,700.
Okay, my simple answer is supply and demand always works.
Yep.
Okay, and sometimes supply and demand. I mean, when the market was dropping, last month, I remember looking at the S&P chart and saying to myself, there's really no very good quality demand till we get down to like 21 to 2,200, and the market was still at 3,000. I'm going, that looks ridiculous. It sounds like too much, and it's amazing. The market manages to get there most of the time. So, and that's why when the market turned and started going up, it looked to me like it could very easily get back up as high, possibly certainly 2,900, maybe even 3,000. But I don't think it's getting much above there. And also, I think it's important to recognize the NASDAQ actually kind of retested a very, very important high. Remember, the NASDAQ's kind of been the sweetheart. That's the one that contains stocks that have actually been making new all-time highs in just the last week or so.
Yep.
So if you look at that as the strongest one, you can see the NASDAQ 100 got very close to that 9,000 area, which, if you look at a daily chart, is the place where it left that very important double top on March 2nd, March 3rd. You may recall March 2nd was the day the Fed did the unexpected interest rate cut.
Yep.
And then the next day was Super Tuesday. That was the day that everybody who was worried about us turning into a socialist country was able to breathe a sigh of relief. But the market never went higher than the little pop it got that day and what I call that Super Tuesday relief rally. So you could see it went right back up, retested that, and that may be if the NASDAQ, if that's as far as the NASDAQ goes, it may be telling us that the S&P is already topped out as well.
Yeah.
That those shorts you have on are going to be good. That we're not going to get more advantageous prices for shorting.
A good comment here from, let me see, where was it? Things are moving up here a little bit quick. Austin says, so this morning with Sam, he said he doesn't think that the market will even retest the March lows. He said, I trust and respect all of you guys, so how do I qualify all of these viewpoints? That's the beauty of markets, period, is you have to base your own assessments and opinions. I would staunchly disagree with what Sam says, but it doesn't matter. One of us will be right. I guess at some point, both of us will be right, because at some point over the course of time, we'll test those March lows no matter what. But you have to look at just the data. You have to look at the prices, and right now things are trending to the upside. So at this point, you still have to have that kind of somewhat bullish bias because the short-term trend since the 23rd for 1 month, we have a 1-month trend, is up. But there's so much heavier weighted stuff behind the scenes that has not hit our markets yet. As I mentioned, 6 to 9 months for some of this data to come through the pipeline and actually impact earnings. That goes to the next question here from Big Eb. Says, when does Bill think that it's most likely to drop to 17 or 1800? Second quarter earnings season, perhaps, or August-ish?
I expect that the market is going to turn the corner within the next several weeks. So, and start down. I'm not sure how fast it's going to go down. I think, frankly, we could get a pretty quick move back to a retest of the lows. Then, who knows? There might be a bit of a range there. But again, if the fundamentals and specifically the earnings continue to deteriorate over time, and it's really hard for me to imagine that they don't.
Right.
I think ultimately, probably by the middle of the summer, we could begin. Bear markets tend to happen pretty quickly when they do. But, again, it might be a very parallel to what we saw in 2008. We made the recovery high in May. We didn't make the absolute low until April of the following year, right? Or March it was. Or April, March. Okay, but still, it's likely to continue. Again, I think the bear market could continue for at least that same period of time, taking us into early next year.
Well, I agree. And again, I'm not a subscriber.
And I want to say something else.
Yeah.
I hope I'm wrong. Okay, I hope that somehow this thing turns out to be less bad than we think, that somehow there is a way to cure it or to contain it or whatever, and that all of what I right now see as magical thinking has some merit to it.
Yep.
But trading taught me a long time ago, it's not about what you're hoping for, it's what the market is telling you.
Right.
That's what we have to pay attention to.
Yeah, and absolutely. And again, no disrespect to Sam's opinion about the market. You guys have different opinions as well, and that's absolutely fine and dandy. I think what makes us all traders, whether it's Bill here or Sam or Brandon or Sam Evans, it doesn't matter. We'll find an opportunity to make money in these markets based off of what it's giving us at that moment in time. Right now, the markets are giving the bulls, the longer-term bulls, a nice little reprieve. I will say that in this nice move up that we have here on the screen on the S&P, or this is the NASDAQ, but either way, I've probably made in the last month, I'm going to say 50 trades. Maybe Sam is just going to be buying along and holding here a few. I'm going to be very active in trading all those little fluctuations. So personally, I would like to see it go down because I think they move much faster. Fear is an unbelievable motivator for people in their panic selling. So I'm kind of looking forward to it. I'm going to shift gears here a quick second because Harrison, you had a couple funny comments today, Harrison. That was awesome, by the way. He says, can you ask Bill to tell the story of George Bush learning to trade at the CME?
Now, I think I'm pretty darn sure I know exactly who Harrison is. He's one of my students from our OTA San Jose Center.
Nice.
So he's taken a couple of my classes. Well, I oftentimes, especially when I'm kind of introducing myself to my students, I like to tell them a little bit about my career on the trading floor. And it just so happens I was in a photo that was taken the day that George W. Bush came to visit the Chicago Mercantile Exchange. He actually walked right into the middle of the S&P 500 pit, and one of the White House photographers took a picture of him, and I happened to be in that photo. So, and I actually got to shake his hand that day. So, but the president, again, like many people, visiting a trading floor at a big futures exchange was really, kind of awestruck, I think, by all the energy, the noise, the color, all the stuff that was going on the trading floor. So, being a bit inquisitive, he asked a few of the traders to kind of give him a grand tour, explain to him how the business of trading worked, what it is we actually did, that basically gave what appears to be a bunch of madness a bit of method to it. And there you go. You can see there's Bill Henner on the right side of the screen. But the point is, apparently the fellows who gave the president the tour and explained the business to him did a very good job, because at the end of the explanation, Mr. Bush turned to the guy and said, "Yeah, you all are right. This isn't rocket surgery."
Oh, I really do miss President Bush.
Yes, I do too.
The humor that we had from that was obviously pretty awesome.
It's really funny until someone gets hurt.
Yeah.
And, he never, well, I can't say he didn't cause some pain too, but, anyway, I don't want to get into politics.
No, let's
never
not.
Good, especially as traders. I always try to remind any student of mine that will listen that ultimately as a trader, you want to be apolitical. You don't want your biases, which inevitably happen once you've got a strong political view, to affect your trading methodology.
Well, you want to piss someone off faster than anything. You start talking about religion or you start talking about politics, which we do a very good job here of not going down either of those rabbit holes, because I want you to believe who you want to believe. I want you to vote for who you want to vote for. Doesn't have a place in trading and investing at all. Another question that came out was, I don't get the gentleman's name, but there was a question on crude oil. Obviously, what we've been seeing with crude oil recently is unprecedented. I mean, stuff we've just absolutely never seen before. I've never seen a negative print, and it was negative $40.
I still, I'm still having a hard time getting my head around that one.
Yeah, like how does that? I mean, to me, honestly, this is the CME's fault, because the CME should have stopped it and said, hey, you know what? At zero, it's done.
You can't. I know. I always, would tell my students. I said the one benefit in theory to being long rather than short is what your ultimate risk is.
Right.
It can't go below zero. Well, so much for that theory. Because if you thought you couldn't lose more than zero, again, that thing went negative $40,000 a contract if you were long.
I was just ready to start stashing some barrels in my backyard at that price. No problem.
Yeah. Right.
So what's your take on oil? Obviously,
you got to be able to store the stuff to be able to redeliver it at the next month's price.
Right.
And of course, you could see what happened with the June contract. Literally, the day after March goes off the board, June yesterday it was traded down to $6.50 a barrel.
Yeah.
I mean, I've never seen a price that low in crude oil.
And it's funny, Bill, when that happened, I'm trying to hit buy orders. I was trying to do buy orders at $7, and TradeStation said, no, you can't trade crude oil.
Yeah, I know. That's a travesty.
It's like your once-in-a-lifetime opportunity, and they're like, no, you can't have it.
I want you to have $20,000 in your account to trade one contract, but they should let you trade it at some level. Even if they need more margin, fine, but don't tell you can't trade it.
Yeah. So, I mean, what's your thoughts on it? I mean,
I think again, it's a perfect storm. It's a situation where, again, we obviously have a huge decrease in global demand for the product. We've, been doing nothing but increasing global production over the last few years. And you've even got, Russia and Saudi Arabia, stabbing each other in the back.
Mm-hmm.
So again, that's really the only way I can explain what's happened here. Just at a situation where there are no buyers. And that, again, on Monday, that was the issue with the expiring May contract. There were no speculators in the market to speak of. There were, again, any day traders who were going long. The problem was there were no shorts in the market that needed to cover.
Right.
And that meant there were literally no buyers when things got ugly. And that's why it got as bad as it got.
On Wednesday, the 20th of May, Wednesday, May 20th of May, so around April, 20th of May, the June contract will be expiring. And are we going to see the same thing? I mean, right? I don't see inventory all of a sudden. There's a whole bunch of new inventory being created, right? It seems to me like we're going to have the same problem. And anybody trading crude oil, that the CLM contract, you might share the same fate as the CLK contract. So, go short oil in the last 2 days.
It may be kind of moot because it sounds like the brokers won't let you trade it anyway.
Well, but I don't think if I was short the CLK on Sunday coming into Monday, I'm pretty sure that unless I was accepting delivery, they would have closed my contract anyway.
Yeah.
So.
Well, no, unless you were making delivery.
Correct. That's a weird one. Bill, what else is going on in your world? I know probably not a lot of classes on the horizon. Anything I can do to promote for you, or viewers get in touch with you?
Final idea before we get off crude oil. I don't profess to be the expert on crude, but of course one of our former colleagues at OTA is the man for that, Mr. John Rowland, and I would certainly see if you could convince him to pop on, because he could certainly talk about crude oil and also natural gas with a lot of knowledge and authority.
It's in the works. It's in the works.
I always love to tell people. He was the man who, he used to handle Enron's natural gas futures business. That's like having Goldman Sachs's orders in your hand.
Yeah, right.
It's actually maybe more important in something as specific as that market. So, but okay, didn't mean to get you off topic there, but
it's all good. Are you doing any teaching? Any social media I can drive people to? Are you doing anything that might want to share with the audience?
Pretty much just dialing things back, trading my own account, and just treating this as an enforced but enjoyable vacation period.
Nice. Well, again, thank you for coming on. Always a pleasure. Once I get the graphic done, I'm working on a graphic that says, it's called Stories from the Floor, and I am going to start to do, I think we'll do a mini-series where maybe we'll do them pre-recorded and post them online, but I'd love to have some little stockpile of just funny anecdotal stuff, because there's all these great learning lessons in the stuff that you have done on the trading floor. Those are priceless experiences where I know your students have benefited from hearing those live. Maybe we can share them with our audiences someday. So thank you so much. Be safe down there in the sunny Southern California, and I look forward to having you on again soon.
Okay, always a pleasure, Merlin.
All right, take care.
Be safe. Bye-bye.
Guys, that was Bill Henner, a great guy. He's such a nice, friendly guy. And, you think of the temperament that these guys out in Chicago had to have to do their job. They were beasts. Some of these guys were just aggressive, very, very aggressive traders. And when they got off that floor, everything was fine, and they were nice and calm and collected. Some of the other ones that's come out, again, Craig Weil and Michael Young, two of the nicest, friendliest guys you'll meet. I wish I would have known them on the floor out in Chicago, because I bet you it's like Jekyll and Hyde. On that floor, you had to put on your game face and really, almost fight for your space. A very cool educational experience out there on those floors. Okay, let me go to a couple little pieces for something that happened today, and I'll check on the intel here in just a second for you guys. I want to show you the earnings calendar. This is really kind of interesting. So I took this picture, this is a little bit ago, and you'll notice the top line there, Intel came out with earnings. And I made an important point with this because Intel is a member of the S&P, the NASDAQ, and the Dow. So that gives it a little bit of extra validity because it's weighted. It's also, I think it's, if I'm not mistaken, I believe it's 3.9% of the NASDAQ 100. So if they had blowout earnings, and it looks here like they did, they had... were supposed to make $1.28, and they reported $1.45. They beat by 17 cents, a 13% surprise. Eli Lilly beat, Union Pacific beat, so it's looking good here on earnings front. Really, let's take a peek at the chart of Intel and see how that has boded over the last, INTC since they reported earnings. I never thought I would call Intel a popcorn trade of the day, but check out these swings in Intel. Intel all over the place. This is the danger, and I've said this so many times, guys, do not trade an earnings announcement, because Intel beat. If you bought long, let's say you bought calls going into the close, or you own Intel thinking, hey, they're going to blow out earnings, you were right. Bravo, you did the right thing, but you got smoked. It's down from 59 to 56, so it's only $3. But still, for Intel, that's tough. That's a tough position to be in. When you beat earnings, my guess is in the shareholder minutes, they've said that they're lowering their expectations going forward, and global growth, etc., are going to be a problem going forward. So that is part of the issue there that you're going to see with Intel. And this may actually bring down the markets tomorrow. Not that it's a heavy portion of the NASDAQ, but let's just go NQ. I'll bring up the NASDAQ 100 here so you can see the futures right now. I'm betting a little bit of this sell-off here is because of the news with Intel. Now let's go back to that earnings calendar page that I put together for you, and I want to show you what's happening tomorrow. Not a lot really. You've got Verizon, Sanofi, Total, Sony Corporation, American Express, and Japan Tab. No clue what on earth Japan Tab is, but that's pretty much what it is coming out for tomorrow. So there's your earnings calendar for tomorrow. I think that pretty much does it for today. How long was our show today? 43 minutes? Big M, you're going to be frustrated. I'm not going to finish in an hour. I'm going to do under an hour today. Cool. Thank you guys so much for all your input and questions. Sorry if I didn't get to all of them. There was a lot of stuff that I was trying to get to, but you guys have had such great comments in chat. Again, if you like Bill Henner, give me a thumbs up out there. If you have anybody who might be interested in the prospects, or somebody who might be overly bullish, and maybe just so you might want to share with them or tell them about the podcast, something to help us out as we try to grow this show. So thank you guys so much. Tomorrow, barring any really dramatic market moves in my account. It's going to be a nice glass of whiskey tomorrow. Have your drinks ready. I will see you guys on tomorrow's show. So take care, everybody. We'll see you tomorrow.